And I was just curious. I wanted to throw that back to you. If you were me and I had $1 million, I'm in an affordable single family market right now with the current trends. What would you do?
So I'll give the real estate and the non-real estate answer.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. How many no's have you received? Did you get a no when you were applying for med school? Have you ever known somebody that's gotten a no from a bank, maybe gone through foreclosure or bankruptcy? And I tell you what, to get through those times in our lives, it requires faith. It requires persistence, passion, just to keep going. And today's guest has got all of that, has gone from every single no you can imagine to now being somewhere where he's actually just recently partially retired from practicing medicine. He's now a fund manager and founder at Baluch Capital. It's a multi-asset platform offering co-investment opportunities for physicians and other accredited investors. He educates investors via best-selling books, Forbes articles, and summits. And now today on this podcast, please welcome Dr. Amir Baluch to the show. All right, Mr. Amir, here we are. The time has come. I tell you what, I've been looking forward to this. Our paths crossed. It was probably a couple months ago, I think. And we were talking about physician wealth systems, and you threw me some great questions, and you threw me some information about your past. And I said, Amir, we got to get you on the show, man. And the time has come. Welcome to the show. I'm excited.
Hey, thanks for having me, man. I think we'll have a good conversation.
Absolutely. So just to let everybody in on some of the background, I always like asking everybody about their medical journey to hear, because you are an MD, you are a physician, and I guess at this point, almost more importantly, you're an experienced investor, and I wanted to dive into that as well too. But tell us a little bit about your experience in medicine leading up to this point, Amir.
Well, it was kind of bumpy, actually. So it was back in 2000 when I put in my application, which is a painful process in itself. But as I applied, I got a couple of rejection letters, and one school was left. And I thought, oh, that must be the one I'm going to be accepted at, UT Houston. And then I got their rejection letter late, and I'm like, wow, I might not be a doctor. So I was kind of freaking out. I started studying for the MCAT, and I was thinking, let me start my own business. So I heard something on the radio. I started some electronic payment thing from my apartment, and then basically lost my life savings in that, which luckily wasn't that much at the age of 21. Now, then I was like, okay, let me go work with my dad, or just live with him, basically, my family back in Midland, Texas. And then he went bankrupt about a month or two later. So now we're living in a one-bedroom apartment. I'm staring at the ceiling, wondering what's going on in life.
Wow.
Well, I was thinking about that. I was thinking, you really can't trust any one path in life, one source of income, one career, one anything. And so I started to overlearn on financial stuff, personal finance, investing, leadership, business. And eventually I did become a doctor. About 2 years later, I got into Texas Tech Med School, in Miami for anesthesia. Now I'm in Dallas, Texas, where I pretty much knew I was going to end up. So doing anesthesia, but I never forgot what I learned when I was 21 reading these books. And that's that the first $1 million that people usually make is in real estate. It's responsible for a majority of people's millionaire status. So since then, I started learning a lot about real estate and investing in general. As soon as I hit the ground in Dallas, got my real estate license, my securities license, started working with a broker dealer, and we're flipping all kinds of real estate. I think we did about 600 million in about 4 years.
Wow.
Transactions. And I still continue to be a doctor, although I didn't tell you this before, but last month I basically have retired. I'm probably just work like 2-3 days a month and maybe do some locums here or there and some mission trips. But it definitely was a long journey. It didn't start out very smooth at all. So, I guess word to the wise, just hang it in there. If you want something bad enough, just hang in there and you can get it as long as you work hard.
Yeah. Faith, man. Faith is the foundation that carries you through so
Right.
many things, so many things. Even when that, like you felt that last thing, that last rejection letter it still takes faith to carry through that, huh?
That was tough. I was in denial. I called them and said, "Look, you mistook me for somebody else. There's no way I didn't get in. There's no way I
Yeah.
didn't. I thought I was a shoe in, but
Wow. Wow. Hey, and Amir, what was, when you're 21, it was an interesting quote, kind of like, staring at the ceiling, wondering what life is at that point. What were some of those books that you picked up then that kind of started that direction?
well, a couple books. So there was so I was in San Antonio at the time, and there was a place down the street called Earful of Books, and you could just get all these books on audio. And they didn't have a big selection. I listened to a lot of things. So a lot of it was Tony Robbins on mindset. Rich Dad Poor Dad actually came out around that time. So that book's been out for more than 2 decades. I read that one. And then I was also a part of Business Network International and the San Antonio Chambers of Commerce, and they were giving me recommendations. So I read some other books like Dale Carnegie, How to Win Friends and Influence People, and a lot of Brian Tracy material. And I actually saw him live. So he was basically like what Tony Robbins is now, but he would sell out, arenas there. And back in the year 2001, he had a lot of things on leadership and marketing and personal finance. So that's how I got started.
I don't know if you see me. I had a smile on my face as you were reading off that list of books. Man, just dropping the bombs in on that piece. And I think starting off in mindset was huge to take that twist. And even Tracy, even before, I guess Rich Dad Poor Dad is definitely a mindset shift, the asset versus liability and getting pulled away from kind of what the masses are taught kind of thing. But just that leadership piece, Robbins, Tracy, I mean, massive, massive pieces. So if there's anybody out there listening, if you were to pick somewhere to start, follow Amir and start in that path. That's crazy. But life just doesn't come up and change for you because you read these books and you went to these seminars, right? So we're stumbling through. You get into medicine, and you just told us congratulations for at this point in your career, Amir, that you're somewhere. It feels like it's good, but even along the way, it's not all sunshine and rainbows. Even after you read those books, unicorns aren't flying around and the answers are solved. It takes faith, it takes dedication, persistence, all of these things to grow in, and just that understanding that this is the way. And it's so hard to find that path when there's nobody that's like pointing us the way, like, come here, Amir, do this, and you're going to get this in 10 years, in 15 years. Right. So it's a challenge, but it's a great start. So we're now back to medicine. Where does real estate come back in? Tell us about your first real estate deal. Well, you told us you started a brokerage, right? And then a securities. You got your license in securities. What's that combination?
Well, being a lifetime student, I couldn't get an MD in real estate, but the closest thing I could get, I figured, was a real estate license. I didn't think too much about it. And I got my securities license also, really because I just wanted to learn from the best. And I thought in some structured environment, until I learned it's not that structured, but I learned a lot on the real estate syndication side from the broker dealer. But you're asking, what was my first real estate experience? So when I was 21, I was like, well, let me buy some foreclosures. And back then, you actually had to go to the courthouse steps, and they give you a piece of paper once a month. I think it was like the first Tuesday of the month. And it gives you a list of people's names and addresses, sometimes a phone number, sometimes not. And you just start knocking on doors and making offers. So I did that, and I had a verbal partnership. Of course, I don't have money for an attorney or anything, but I had a verbal partnership with another guy to fund it if we could buy a foreclosure and fix it up. And that never panned out. Then I tried buying a rental property when I was in medical school. I was like, let me get this duplex. And it wasn't that expensive, about 120 grand. So I figured my payments around $700-800 a month. And I had a guy that would rent out the master for 800. So I'm basically living for free.
Right.
Ended up selling to one of his friends instead, but I did get approved and I put in my offer. And so that didn't work. And then there were some other bank repos that I found online, and I put in offers and got outbid. So eventually I did do a transaction while I was still a resident. I was second year resident in Miami, and I teamed up with people in Dallas that needed somebody to co-sign on a loan on a short sale that they were buying, and they had a team. So now I'm partnered with teams and mentors, and we did flip that condo, and I made about 17 grand out of that in the middle of residency, which anybody that's listening have been through residency, even $1,000 means a lot. So,
Perspective, man.
Yeah, I pretty much paid down a lot of credit cards with that 17 grand.
Yeah. Yeah.
I was very happy for that one. And then it was like, okay, let me go to Dallas and do something bigger. Oh, another failed transaction. My last year of residency, we were putting together a commercial development deal, a gas station and C-store off of I-30 in Cockrell Hill. It's basically it would be the first exit on the way to Cowboys Stadium, and they didn't have a gas station. So it seemed like a killer deal. I should have made 800 grand in the deal. My co-signer backed out the day of closing. So we closed on the land only, and with the money that we raised, and then we sold the land. 40 grand net profit means nothing. It's basically a break even. So there was a lot of stumbling blocks that, I know a lot of people don't talk about the stumbling blocks, but you learn more during those than you do from the wins. And so that's a whole other podcast in itself. That's when I was like, let me just get into some transactional stuff. I signed a contract to help somebody buy a rental property or their dream home. Hey, there's not that much risk that it's not going to close, right?
Right.
Like it's not as much headache. So that's why I got the licenses. And then the best thing really was that securities license to me was just as powerful as my MD license. Understanding securities and mainly due diligence. Like this due diligence is crazy. So when you're working with a broker dealer, you're not going to be raising money for somebody that isn't, as clean as a whistle with an amazing track record. And it costs a lot to put these things together. And so that was a great learning experience for me over 4 years. And that's the reason why, I ended up being able to leave and create Baluch Capital.
Wow. Man, what a journey. What a journey, man. So many no's to get to that yes. There's so many no's. And on the sales, so we had I had a direct to seller real estate acquisition company myself, single family. So we were direct to seller. All those instances of you writing offers, to me, it makes me happy because you were writing them low enough, which means you were writing offers that made sense, right? Because it takes so many no's to get to that yes. But just like I tell the sales floor is that, I didn't make this up. I'm not going to steal this from somebody. That no is one step closer to a yes, right? Right. And it takes so much, but it's so difficult in the real world because it's emotional. You get tied to these offers. You get tied to the time that you put into these things. And I just also tell everybody to watch out, because when you're tied to that emotionally, you start trying to make a deal and not find a deal.
Right. That's exactly right. And actually, even right now, I see, people that, I'm not going to name any names, go to certain masterminds and they have the money and they're determined to just close on something. And they forget the goal is actually to make money, not just close on something and they'll bid whatever it is to get that deal. And that actually ruined the market for a lot of people the last couple of years. So that's why I actually kind of stepped out from the multifamily back in 2019, because I felt too much of that was happening. But also what you said about just getting all those no's, that's why it's actually so important to be around people like yourself that talk about this and just let people know, look, you're not alone. It's okay to get a bunch of no's and hit a couple walls along your way to success. Like that's just normal. For me, there were no masterminds in 2000, 2001. Like I would just listen to audio from Brian Tracy and he would say, yeah, for every time you get a no, you're closer to a yes. Every 10, set your KPIs, every 10 no's, get a maybe. And that might be good. And just, set your expectations accordingly. So, but now with podcasts and masterminds and online groups, you can actually talk to other people about it. You don't feel as bad. So all this community stuff and this podcasting really helps with that mindset.
Yeah, yeah. And learning, building that foundation to learn, but then taking action. Just another caution out there too, Amir. And just like you're saying, there was somebody out, doing these lectures, a guru or whatever, and kind of misleading. So we always tell everybody too that just because you're in a mastermind with somebody or somebody's leading a mastermind or what you're seeing on social media is not what you need to see totally for most people, right? Because you're being sold that image, you're being sold. There are plenty of people out there that have amazing integrity, just amazing experience, will lead you in the right direction. But even in those times, a lot of the stuff you're going to see out front is what they want to show you.
Right, right.
Sunshine and rainbows.
That is 100% true. That's why it'd be great to do like an episode just on the headaches. There's so many nuggets of information and learning from there. I would say if anybody's into those masterminds, ask them about some of their worst deals that they did and reverse engineer ways to avoid that.
Yeah.
Being an investor, I tell people, is more about understanding risk. So after a while, people understand cap rates, ROI, all of that. Annualized return. You can get all that with a calculator. That's when everything goes right. But how do you plug holes into what goes wrong? You need to talk to people that have a lot of experience. And once they tell you what went wrong, you need to go back and think, okay, well, how could that have been avoided? Because the more you could avoid these pitfalls, the more you could compound your wealth. And that's a big name of the game, right? Because rule number one, Warren Buffett says, is don't lose money. Rule number two, see rule number one.
I love that. Uncle Warren, man, when we were doing the single family thing, fix and flip style. And once we started, I guess not necessarily transactional, but wholesaling, houses, it was so much easier. It took less people per se, but when we stopped flipping 2x4s and started flipping paper, things changed. But in that idea, man, I had, I was starting to film a lot more and trying to share this experience. One time we were doing 6, which is not the biggest in the world. It's relative. That's a lot. It's stressful. And during that 6, man, there were so many things that went wrong, so many no's, so many mistakes, so much just stress. And we were thinking, okay, we want to show this to everybody because it's not perfect every way through. Everybody wants to pull the shiny stuff out of it and say, wow, you made 60 grand on this flip. And, at that point it's like, okay, yeah, but look what it took to get there. I mean, when you buy a house for $10,000 and you got to, suit up to get into it, and, you're fighting off it getting demolished by the municipality. Like there's so much stress that goes into it. And everybody from the outside and social media and watching life through a TV show sees just, wow, 60 grand. I should do that.
Right, right. No, that's true. I mean, but remember, they're trying to sell you like a mastermind. So they don't want to scare you and then you don't get into their mastermind. So you kind of got to be careful. Like, when it looks too good, it probably is. Like you definitely want to see how they're overcoming obstacles. And if you're just getting into it, it makes sense to partner with somebody that's been there, done that, because they've seen those headaches that you might not have seen.
Mm-hmm. Yeah. What happens when, like I love asking this question now. I'm not yet into multifamily. But I love asking the question, okay, what happens now when the bridge loan is, the gap loan is expired, when the insurance has rose, 40%, when the taxes have risen, what happens? How do you address that? What's the protocol, right? And same way in single family, what happens when interest rates change during your renovation? The renovation takes too long. You can't get your projected rent. So what happens during these times? What happens when somebody breaks in and steals something when you're renovating a house? Right. Just great questions, man. And you have not left real estate. You're still doing real estate deals now. So tell us a little bit about, Amir, where you're at now with real estate.
Well, so in 2011, we started off just doing fix and flips on some single family rentals. And then we're figuring, hey, every time we go to the city to get approvals, it takes just as much time to get approval for one house as it would for maybe a whole subdivision. And so we wanted to scale. So the natural progression is to become single family home developer. So now we develop basically multiple subdivisions around Dallas and some of the suburbs of Dallas. That's our main real estate focus. It doesn't mean I won't jump back into some commercial here or there, but I really like what you could do with single family, and the fact that the valuations are not tied to the NOI for me is actually an advantage. So, I really like that aspect of it, especially when, 2015 to 2019, that's when we saw cap rates and interest rates at their lowest, which is a seller's market. So for me, it was not a good time to go into buying properties in a seller's market. So I sold everything. But multifamily, when you buy, it's so complex. I tell people, my physician friends, this is like the neurosurgery of real estate. There's so many things that have to be orchestrated, and it's so complex, and it takes a lot of good relationships with the city and planning and things like that. But the fact that it's so difficult to execute, there's not as much competition. And you're usually buying land from people that have no idea what the numbers are at the end of the day. So I think it's actually easier to negotiate. And even though it's harder to execute, meaning it takes more time and more skill and more coordination, it's safer because you could come in with some discounts almost whenever you want. Like, all of our deals are off market. People are willing to sell their land. People buy land to land bank and they don't know how to develop. So if you're not a developer, you don't know what your land is really worth. It's not really based off of comps, which is a whole other conversation. And most people like with the developments you do, I'm sure a lot of people talk about the Burr method. You have some value add, cosmetic value add. In multifamily, the value add is maybe renovating the units, increasing the rent, increase NOI, flip it at a higher NOI multiple. So in single family, you could take raw land, and the value add is just get it permitted correctly. That's now the value of the land sometimes can double off of that, and you're leveraging into something that could double in 6 months. So you could actually make like a couple 100% in a year. Or you could keep and sell it, or you keep that and then develop the lots, and now the value goes up again, and now you could sell it to builders, or you keep it and you build the vertical, because the vertical is the next value add, and then as you're selling, you could upsell on certain appliances and upgrades, which usually those have 50 to 80% margins, which is kind of the final value add. So there's like a 4 to 5 step value add, and you can get out in multiple areas in that development. So that's why I like it. There's multiple times you get in and out, and you can always step back and see what the market is doing and make a move.
When you say build a vertical at that point, you're talking about actually sticks and stones at that point?
Right. Actually putting the house up.
Interesting. Yeah. I see the smile on your face as you're telling me this too.
Most people don't know this. I've never really heard somebody explain single family development on a podcast or YouTube. So
some of the risk tied in with those too. So I've not done a new construction development. I almost did. The day before we were going to break ground, we sold the property.
Oh,
day before, man. And it was just one of those things. It was, I was brand new at everything, and I had so many other things going on. But ultimately, one thing I did pick up through that process was sometimes, depending on the size of the development, you become your own competition. So when you, depending on how many houses you have, how many phases you have, you become your own competition by all of a sudden you're comping against properties you've already sold and have been sold again.
Right. So it's just kind of like the diamond industry. There's plenty of diamonds in the world, but why is a diamond worth something? Because the people that control the diamonds only put out a certain amount in the market, right? So the same with developing. We might put out just 1 or 2 homes at a time, let it sell. 1 or 2 homes at a time, let it sell. And that way the supply demand is in our favor because we're controlling the supply. And we go in there knowing what the demand is because we can look at the absorption rate in the area. And also we mainly stick in the affordable home area. We like people to get FHA loans. That's the biggest market. So the biggest market means the most amount of demand for our homes. So that's our model, and this relatively safe model in the world of development. I know other people, they will build luxury homes, which have some amazing margins, but we do less margin and more volume, and we still will get, project IRRs like in the 50s.
Oh, wow. Wow. That's crazy. When you're controlling the number that are being put out, it's almost like you're not doing, like you're saying, you're not doing 100, 200, 300, 500 house developments, right?
Right,
Do you use firms to do, you spoke of absorption basically, and I guess from my perspective, that's how fast a house goes up for sale and gets sold. Is that correct?
Right. Like how many houses are being bought in that area over what period of time?
And you use analyst groups to do these studies for you?
We have in the past, but usually just my brother, who's full-time with us on Baluch Brothers Development, he just looks it up on the MLS.
Okay. Very cool. Very cool. So inventory, stuff like that. And you mentioned your brother, and you've got somewhat of a family business going on there, huh, Amir?
Right. So he used to, believe it or not, he was just a pizza delivery guy for Papa John's, which has excellent pizza, by the way.
Yeah, I agree, man.
He did, while he was delivering pizzas, he got his business finance degree, and I was paying for him to get his MBA at UT. And halfway through, I said, look, I don't think you need this. I think it's time you need to come over here and write your own checks and start growing Baluch Brothers Development, because I can only get it so far while I'm still in the OR all the time. I need somebody on site managing our subcontractors. And so that's when we started to really scale up our flips and get even better rentals. And then at that point, I just started managing the capital stack, and he was the boots on the ground.
What was the hardest part about working with your brother?
We're always going to butt heads on things. He wants to do this. I want to do that. I'm type A personality. He's type B. I want everything done yesterday. But it's actually been pretty good. So at the end of the day, I'm still writing the check, so I still have some most of the control of it. But he's actually better. He's with his eye to know how to value engineer these houses. They're pretty much clueless at that point. So he creates the value that way. So, and he's good at those numbers too. His business finance background helps with that. And so now, like if I put together a pro forma, he'd go in there and make it have a little bit more detail in it. So we have a custom acquisition pro forma that we use when we do land acquisition.
Is he younger or older?
It's a few years younger.
Interesting. I'm asking Amir because I've worked with both of my families. Both of my brothers, older and younger, and just that journey of writing the checks, different type personalities, and just it's always interesting for me to see that, see how that works for everybody else too.
Well, speaking of personality, so now that in some other masterminds that I have on that are specifically for developers and some just for business owners, whenever you bring somebody on, it's good to work to people's strengths, right? You don't want to put somebody in a position where their job is their weak link. So now everybody on our team does the DISC personality test. And there's another one starts with K that I always forget. I always have to search it in my email to let you know, hey, are you introverted? Or are you extroverted? Like if somebody's not a little bit extroverted and they're going out here managing contractors, I don't know if that's the best thing, but let me tell you, if somebody's introverted and they want to be our bookkeeper or manage the financial, that's great, right? There's behind a computer and get stuff done. And also will show you how to communicate with people on your team. So like for me, if somebody wants to talk to me, I'm just get right to the point, cut out the BS. Don't tell me stories. Just get straight to the numbers. That's how
I like it too. But then people have feelings. People have feelings, and we gotta stop and talk about feelings and all this other stuff. And it's just, for me, I've been learning, Amir, when it comes to managing people. And I had a a teammate to work with me within the last couple of years here, and he had managed lots and lots of people. This was C-suite, retired, awesome guy, just great guy, was just giving me as much knowledge as possible. One of the things, I guess the most valuable thing I feel like I took out of the mentorship as he worked with us on our team was, that I had some guys on the team that were 35, 40, 45 years old. And he told me, he's like, Brett, these guys, they're grown men. They're not going to change. They are who they are. So you basically have to find that path or that journey for them that fits with who they are. Because as soon as you try to start changing that person, you're not getting anywhere. You're going to be battling. It's just be a constant wheel of coming back to the same thing. So right. You shake your head like you agree on that one, huh?
Yeah, no, we did. Because, we had those problems with some of my other companies and some of my executive assistants. Like, we had to terminate some of them, just wasn't a good fit. But now most people on my team are somewhat like me. My top guys are, all the COOs are. And then now if we need somebody extroverted, we definitely put everybody through these personality tests first, and that avoids a lot of friction. So there have been times we hired like the wrong people, the wrong construction managers, forcing them into a role that didn't fit their personality. So, everybody can excel in their own way. And that personality test, it is an extra step, but I think it's totally worth it if you're trying to build a team.
And the biggest way, I guess, to scale is just that. You've got to have the right people. You got to have the right people. You got to give them the right resources. And those are the things. It's like, if you hire the wrong person, keeping the wrong person for too long is a whole nother. There's a whole nother podcast we're getting into here, and a whole nother topic of the people thing. But it means so much to have the right people on your team. Absolutely. You asked me the first time that we had a conversation, what I would do with $1 million. And I've been thinking about this, and my lane currently is single families. And we have, plugged into this little lane where we can acquire, I guess not necessarily aggressively, but consistently, getting through data, the way that we're plugged into the data, filtering data, and making offers, those kind of things. And I was just curious. I wanted to throw that back to you. If you were me and I had $1 million, I'm in an affordable single family market right now with the current trends, what would you do?
So I'll give the real estate and the non-real estate answer. So I'll do the non-real estate first. On the non-real estate, I would buy existing businesses that are selling for a 2 to 3x. And basically the X, like the multiple that you buy on the EBITDA or the net income, it's basically like the inverse of cap rate. So a 3x would be a 33 cap rate. So people know what cap rate are. That's your return on your investment if you bought something all cash with no leverage. So most multifamily right now is at a 5 cap. If you bought all cash, that's 5% return. Nothing really to brag about, but you could buy a business at a 33 cap. So, and I did do that. I bought a med spa and grew it to 8,000 patients and flipped it. So that was fun. So, but that was like a lot of cash flow from day one. You get so much cash flow. And once you get cash flow, now you could leverage more into the real estate, right? Because when they underwrite you, they won't always underwrite the project. But when they underwrite you, they want to see that you personally that are guaranteeing the loan can cover this debt service coverage ratio, at least 1.25, right? So when you do the single family, maybe your whatever your regular job is, so if they're a doctor listening, maybe it's their internal medicine income, their cardiology income, whatever it is, you got some excess income. Okay, that's going to cover the debt service coverage ratio on your first, second, and maybe third rental. But at some point, if those things are not cash flowing enough, you're going to be capped. And so I think thinking cash flow first is a better way to think. Like if I go back in time, I might have done that. But I did start off with a fourplex as my first property and doing some quick in and out cosmetic flips. But that's what I would do now. I'd go for cash flow first, which buys you the ability to leverage, and then leverage is the supercharger.
Leverage is the nitrous oxide Even when we were, back early on doing the fix and flip stuff. And I always hear this a lot. I'm thinking about getting into real estate, but I don't have the time. I'm thinking about getting in real estate, but I don't have the money. You have just as much time and really access to money as a lot of other people, but other people's money, the old OPM acronym is what was the racing fuel for our engine.
Right. And also and just like the nitrous, you got to be careful because you could get burned too. So for example, if people are over leveraged, you definitely want to stress test your deal. Like what if you have 6-month vacancy? Do you have the cash sitting around to float that thing? You don't want to get stuck. You don't want to be forced to liquidate. So it's especially true in development because land really doesn't cash flow. So whatever the note is, I need to have 3 years, 4 years of interest reserves sitting in my bank account cash. And you got to factor that into the pro forma. And so you just have to do that. But the more cash flow you have, the less you have to worry about having excess cash for emergencies, right? Because you got cash flow from multiple sources.
Yeah. So right now, it's interesting. And I'd watched a little thing on your Instagram, which is, for everybody out there, it is Amir Baluch .md, right? AmirBaluch.md. Tons of cool stuff on there. But I was briefly looking at that, and I saw a lot of stuff about negative cash flow. And it's interesting you're talking about cash flow now. And it makes me think, Amir, of, if I'm building a portfolio of in the BRRRR strategy, what about because I can grab lower quality properties that are already cash flowing, already rented up, and hold them in cash. If I have that capital, hold them in cash, I'm instantly cash flowing and have the potential to do the renovation and refinance later. That may be like a good foundation to put a few of these into a portfolio, right?
Right. You could do that. In fact, I know one of our friends, he does everything cash. He partners with 7-figure check writer, and they flip luxury homes, but they do it all cash. So it's lower risk, but big, chunks of money if you're flipping, 7-figure houses, right? And that's their model. And right now, when interest rates are so high, I mean, imagine you just buy something cash, you're saving 7-8% a year. I mean, some people are pretty happy with 7-8% a year.
Yeah.
So, that's not a bad thing to be buying cash now. And then if interest rates go down, you can always refinance and get money back. And that's a non-taxable event. So it's just a financial restructuring. Now you have that tax-free cash out of the house, and you could leverage into another deal by putting a down payment on another deal. So going in cash first is not a bad way to look at it. I don't think a lot of people will do it unless they have a lot of cash sitting around, but
right.
It's not a bad way to do it in a high interest environment. So it gives you the ability to come in and out and, you can really control your finances depending on how much you refinance out of there. You can manage, hey, do you want more cash flow? Then, keep more cash. If you want a little bit less cash flow, but you want to grow your net worth more and expand your portfolio, you're going to leverage more and refinance more of that money out.
Mm-hmm. The famous quote from my father-in-law, who was one of my very first business mentors. He had he made millions making with pennies, I guess the best way to put it, because he was a grocery store owner, and went from the bagger up to owning a few stores. And man, when I first started watching, I'd fill out your personal financial statement that first time. I mean, that's something to celebrate in itself, because then you're tracking. If you're not measuring it, then you can't increase it, right? You don't know if you're getting better or not. So that PFS, that personal financial statement, you mentioned net worth, was a way to track that net worth. And I watch this thing, I grow it, I get more real estate, I grow it. Man, I'm excited. I'm smiling. I say, listen here, father-in-law. And he said, well, buy me something with that net worth. Gone. I had nothing. I could do nothing, right? It's just, I was so cash broke, but paper heavy in that scenario, so just watching that grow the net worth thing, where it's interesting to me now having these conversations about cash having cash on hand, cash flow. We buy to cash flow on these properties. And it's very interesting to look at some of these scenarios on how much is this going to put out? How much should I leverage? How much should I leave in the deal? Right? What are these returns? So lots of opportunity out there, lots of stuff going on. But I also want to talk with you, Amir, on this thing. So before we started, you said that you have these, we know you have this experience now, and you were telling me something about some access to some resources that you're going to give away to the listeners.
Right, right. So a couple of things that might be interesting is I have condensed a 5-year pro forma on a single rental to a single page Excel file. And it's just, I think it's good to start really simple with the numbers. And all the Excel files, you change one number, the whole thing changes. It shows like your 5-year annualized return, your overall return. You can change the leverage. You can change interest rates in the banks. It's just one page. And it's good if you're kind of easing into this to just get that overview. And then, they have you, if they want to get into the more finer details, they could jump on a call with you or use your turnkey system. So I think that's a good way to jumpstart them. And some people are a little bit afraid of getting in because they think it's too complicated. Well, let's start off with something really simple. And another thing, a lot of reasons people get into real estate is because of the tax deduction. So I'm going to have my little checklist of tax deductions that a lot of doctors should be looking at, and some of them are not. And even older doctors are not. For example, just last week, I was on the phone with one of my primary care buddies in South Texas. And, I'm not going to name any names or even name the city, but that he lives in, but he was making payments to the IRS for back taxes. He owed so much tax. He didn't know he was going to pay that much taxes last year. So I'm like, bro, it's okay to send me your personal financial statements. He had bought 2 pieces of property. He bought like a second home and then bought investment property. I'm like, bro, you didn't even depreciate any of this. Like, if you do this, this, and this, classify it like this and this, use my CPA, I'll give them a heads up you're coming. You're probably going to get about $150,000 back, but you're going to have to amend your 21 and 22 taxes. But it's worth it to get $150K back. And he was on a payment plan for about $47K. So that's a pretty good deal.
Right,
but
right.
Tax advantages, some of them seem so simple, but if you miss them, you miss them, right? And such a pain to do an amendment down the road. So might as well just get it all done now and don't miss the big one. So I'm going to send that to you guys as well. If you want, you just go to baluchcapital.com, which is, where is it, over here somewhere?
Yeah, it's up on the board. Yep. So for the listeners, it's BALUCHCAPITAL.com.
And / real estate mogul MD.
That's awesome. Awesome. So baluchcapital.com / real estate mogul MD. And we've got this, the one pager showing five years of returns for a single family, which is very, very interesting. Look at. So I have this conversation so often, Amir, is people trying to basically compare apples to apples. And for me, living in these numbers for so long, and it's like, oh, well, what year of the property are you talking about? Right? Because things are going to change along the way. But just trying to keep it simple is the hardest thing. And we've all heard Einstein talk about it. If you can't simply explain something, then you simply don't know it. Right. So understanding the simplest versions or I guess perspective of this is key. And then these tax advantages are massive. You and I are not CPAs. You do have the MD at the end of your name, but it's not tax doctor, right? So just a little disclosure out there, but we can all talk about what we've done personally and how we've benefited from it. And really for us, where we're recording this, it is the end of Q3 in 2023. And now is that time where if you're listening to this and you're like, I don't even know what I'm going to be doing in taxes, you better be getting on it right now, because if you don't now, you're going to be too late. Reactive versus proactive.
You got it.
So jump on that. Check that site out. I loved our conversation. I know you're a super, super busy man, Amir. I appreciate your time so much.
Yep, I'm glad to share some knowledge and talk to everybody on here today. If anybody's got any questions, they could reach out.
That's awesome. Thank you so much, man. And to the listeners, thank you for your time and your attention today, because without your attention, your time is not that valuable. So we appreciate you hanging out, giving us a listen. Drop on by that website and check out Amir's stuff. Again, the experience that this man has, it's just amazing. Absolutely amazing. It's baluchcapital.com/real estate mogul MD. And man, you know where you got us, and you know where you can come back and see us again. We appreciate it. If you have any questions for us, please send me an email, info@physicianwellsystems.com. And I'm excited to see you on the next show. Thanks.